Hey everyone, welcome to another Explainer. Today we're diving straight into a fascinating, massive structural problem in global logistics, and honestly, a pretty futuristic solution to fix it. We're looking at Project Dynamo. It's an initiative led by the BIS Innovation Hub, and we'll see how they're using blockchain to literally rescue deep-tier supply chains. If you've ever wondered how things like decentralized finance and smart contracts can actually leap off the screen and solve real-world physical problems, well, you're absolutely in the right place.
Let's kick things off with a massive number, $1.7 trillion. Yeah, trillion with a T. That is the global trade finance gap identified by the Asian Development Bank. To put that into perspective, this massive shortfall represents the micro, small, and medium-sized enterprises, the vital engines of our whole global economy, who simply cannot get their hands on the financing they need just to keep their daily operations running. The crazy part? The money exists. The traditional system just can't get it to them securely or efficiently. So to really wrap our heads around how we close this gap, let's follow a bit of a story. Meet Logi, our logistics hero. Logi represents what we call an anchor buyer. Think of a massive, well-funded corporation sitting right at the top of the supply chain. Today, we're following Logi on a seriously high-stakes mission, figuring out how to funnel critical capital all the way down to those vulnerable, deep-tier suppliers who actually build the tiny parts that make Logi's products possible. Now, in a traditional supply chain, doing this is like driving in heavy fog. It's riddled with friction. Sure, the anchor buyer has visibility into their immediate Tier 1 supplier, but looking further downstream to Tier 2, Tier 3, and beyond, the visibility just completely drops off. Because of those blind spots, the powerful financing schemes that downstream buyers offer just fail to reach them. Those smaller suppliers are left totally disconnected from capital, they face terrible cash flow crunches, and frankly, it makes the entire supply chain incredibly vulnerable to disruption. Okay, so let's get into the fix. Section 1, enter Project Dynamo. Through an amazing collaboration between the BIS Innovation Hub, LinkLogis, Standard Chartered, and others, we get Project Dynamo. It's a groundbreaking prototype that takes decentralized financial technology and drops it right into the middle of the traditional trade finance industry. To pull this off, we need to define our hero's main tool, digital trade tokens, or DTTs. Think of these as programmable, glowing digital coins minted on a blockchain. Actually, scratch that. It's more like a highly secure digital contract that uses decentralized finance to execute payments automatically. And to be totally clear, this isn't crypto speculation. These tokens are purpose-built to plug that $1.7 trillion gap. It's really night and day when you contrast the two. The old system relies on isolated data, leaving those deep-tier suppliers completely vulnerable. But the new way? By adopting blockchain, we suddenly have perfect visibility and programmable, conditional payments reaching right down to the smallest suppliers. It completely transforms a disjointed, messy chain of IOUs into a transparent, instantly verifiable ledger of digital assets. Moving right along, Section 2, Logi mints a digital token. So how does this whole thing kick off in our futuristic logistics tower? Well, Logi, the anchor buyer, wants to place a purchase order. But instead of just emailing an invoice approval into the void, Logi initiates a completely digital programmable payment. Logi grabs a DTT from the issuer and makes the payment with hard-coded conditions. Bam! At that exact moment, a fiat-backed token is minted, and it's programmed to automatically execute, but, and this is key, only when specific real-world conditions are met. Now, I know what you're thinking. Is this just imaginary internet money? Absolutely not. Logi's token is heavily backed by real-world assets to ensure total stability. Based on the prototype, Logi has 3 solid options. The token can be fiat-backed by a non-bank fintech like LinkLogis in segregated accounts. It could be fiat-backed by a fully licensed bank like Standard Chartered, or it can be backed by a corporate letter of guarantee. That rock-solid backing is what gives everyone down the line absolute confidence in the token's value. Section 3, splitting the glowing coin. When Logi passes that token down the chain, it's locked. It's an unrealized DTT, but just because it's locked doesn't mean it's useless. This is where we see the absolute superpower of the DTT. The Tier 1 supplier receives this unrealized token, and because it's digital, they can fire up a sort of digital laser. Okay, it's just code, but you get the picture. Split the token and instantly pass a fraction of it down to a Tier 2 supplier to settle their own bills. And then Tier 2 can pass a fraction to Tier 3, and so on. The working capital penetrates incredibly deep into the supply chain. Just look at the power these deep-tier suppliers suddenly hold.
They now possess a fraction of Logi's original token. They can hold onto it until maturity, they can transfer it again, or, and this is a real game changer, they can take this unrealized token to the DTT marketplace and cash it in early with institutional investors for an immediate, slightly discounted cash injection. That is instant working capital for the smallest players, all secured by the heavyweight credit of Logi and the issuer.
Section 4. The Smart Contract Vault.
Okay, hold on a second. With all these token fractions zipping around the deep tiers and being traded for early cash, we have to ask, how do we prevent fraud? How do we actually guarantee that Logi gets the physical supplies before the final money is permanently released to all these different players? Well, the token, even as it gets split up and traded, remains locked inside a high-tech smart contract vault on the blockchain. This vault relies on data protocols and things called oracles. Think of oracles as secure data feeds that confirm real-world events. They are literally the bridge between that physical shipping container on a dock and the digital blockchain. Which brings us to the really exciting part. Section 5, automating the final delivery. This is the climax of the whole process, unlocking the vault. The deep-tier suppliers built the parts, the goods are on a ship, and investors are waiting. The vault automatically unlocks in a super precise sequence. First, the action. Goods are physically delivered. Second, the data. The carrier updates the status, crossing a digital geofence that pings our oracle. The token upgrades to confirmed. Finally, the time. The maturity date hits. Boom. The smart contract executes instantly. The token becomes realized, and it automatically converts into hard fiat currency, settling everyone's accounts perfectly. No chasing invoices, no manual wire transfers. Mission accomplished for Logi. By acting as the anchor buyer and using these DTTs, Logi has completely stabilized the supply chain. The BIS report hit the nail on the head here, concluding that this tech offers a radically new avenue of financing for SMEs. Because the data is transparent and immutable, investors can easily assess the risk, funneling vital capital to the companies that need it most, and absolutely stimulating economic growth in the process. So if a programmable digital token, split into pieces and locked in a smart contract, can bridge a $1.7 trillion gap in global logistics, we really have to wonder what decentralized finance is going to revolutionize next. Think about your own industry for a second. Where are the blind spots? Where is the capital getting trapped? The tools to fix it might literally just be a smart contract away. Thanks so much for joining me on this explainer, and keep questioning how the systems around you are built.